Hello everybody, Jim Farron here again from Farron Capital Advisors in Pleasant Grove, Utah. It's time for another follow-on training to our video webinar on the new tax law. Today we're going to jump in, we're going to dive into the weeds just a little bit on one of the most promising yet potentially confusing parts of the new law. Today's discussion is very important for business owners who report their business income on their own personal tax return. Self-employed doctors, dentists, and other professionals will especially need to know what we are going to discuss here. The Tax Cuts and Jobs Act of 2017 was more about business tax rate cuts than anything else. And this is apparent in the corporate tax rate being slashed from 35% to just 21%. But in the same spirit, there is a major tax deduction put in place for small businesses. These businesses are called pass-through entities, because the business income passes through onto the owner's personal tax return. These include simple sole proprietorships that report their income on a Schedule C. It includes Subchapter S corporations. It includes LLCs and partnerships. In order to treat these small businesses in a similar way to corporations, a new deduction has been created under a new section of the Internal Revenue Code, Section 199A. That's a capital A. So we have started to call it the 199 Cap A deduction. It is a deduction of 20% of the net profits of the business. The net profits are called qualified business income, abbreviated as QBI. So we also call the deduction the 20% QBI deduction. The deduction is pretty simple in concept. If the net profits of your business, or QBI, is, say, for example, $100,000, then you will take a deduction of 20% or $20,000. Only $80,000 of your business income then is actually taxable. It has the effect of reducing your business tax rate by 20%. So, for example, if you find that as a business owner you're in the 24% bracket, then your business income after the QBI deduction is effectively taxed at just a 19.2% rate. That's the simple part. And it generally stays pretty simple up to certain income thresholds. Thresholds of $157,500 for single taxpayers and $315,000 for marrieds filing a joint return. Conceptually, if you are married and file a joint return and your business income is $315,000, you could take a 20% of QBI deduction totaling $63,000. In a 24% federal bracket, that deduction saves you $15,120 of federal income tax. And depending on how your state chooses to handle this, it could save you some more on your state income tax, like maybe $3,150 at a 5% state rate. Now, combining the federal and state savings, tax savings, would be worth over $18,000. And that is $18,000 per year, every year. So this is pretty important to us. The QBI deduction becomes much more complicated at higher income levels. After your income exceeds the threshold amounts, then certain limitations and phase-outs happen. This gets kind of complicated. You will definitely want to ask your CPA about how these affect you. But let's review some of the more important issues. First, if you're a professional service provider, and this includes doctors, dentists, lawyers, accountants, even athletes, actors and artists, and financial advisors like me, then there is a phase-out trap that can be especially costly. The trap works like this. The deduction is phased out on incomes over the thresholds. For married filing joint, that number is $315,000. The phase-out is complete at an income of $415,000. So think of this. As your income increases by $100,000 from $315,000 to $415,000, not only is that a $100,000 increase in your taxable income, which you would expect, but you also lose the $63,000 QBI deduction as it is phased out. So that $100,000 increase in actual income really increases your taxable income by $163,000. That means you'll pay over $47,000 of federal tax on that $100,000 of income. That's almost 48%. Add in state income taxes, and the total tax bill could swell to almost $56,000. That's 56%. That's a lot of tax to pay on a $100,000 of income. I know some doctors and dentists will just stop taking patients once they hit the threshold income limits. But there are other planning opportunities, and we should discuss them. Let's finish up here with a few other happier thoughts on the 20% QBI deduction. If you own rental real estate that you report on your Schedule E, it may qualify for the QBI deduction. If you own real estate investment trusts or REITs, they might now qualify for the QBI deduction too. We discussed REITs as one of our 7 strategies for generating retirement income in another video webinar. Well, they just got better. Now, they not only generate attractive retirement income, but now some of that income comes to you tax-free, courtesy of the 20% QBI deduction. So you don't just have to be a business owner to use it. A lot of investors will too. The 199 Cap A or QBI deduction creates a wonderful opportunity for tax savings. It can be pretty simple, but on higher incomes it will also become very complicated, but still worth it. If you'd like for us to do an income tax analysis and comparison for you, please click on the link below to schedule a time for that. If you'd like to explore if the QBI deduction will apply to you, then click on the link and we'll talk about that. When it comes to planning and preparing your taxes, we will definitely refer you back to your own CPA or tax preparer. But when it comes to analyzing and reviewing your tax returns so that you can be better informed and better understand your situation and opportunities, then we can definitely help you with that. I hope you found this useful. Click on the scheduler link below and let us help you to review your tax situation. Thanks for listening today. I'm Jim Farron, and this is Farron Capital Advisors in Pleasant Grove, Utah. Why don't you give us a call?